What on earth do you do with this one this morning?
Jonathan, I haven't heard you say it yet, but this is a great example of where the first reaction is not necessarily the last reaction. I think we got to rewrite these headlines, everybody. This is about the private payrolls, and private payrolls disappointed to the downside. Mike McKee just talked about it. The upside surprise, it's government, and that may be surprising. Federal government was down. That's not surprising. That's Doge and the cuts. It's state and local that's very high. If it's education, to me, that sort of sounds like there's a lot of education workers coming back into the job market in June. No, that's a seasonal adjustment effect. So the story here is not the headline. The market is reacting to that. Maybe it's the algos. Let's get the humans back in the room, back into the trading, and look through this report. This is a slowdown and a little bit disappointment on the private payroll side. You look at private services, it's well below 68,000. It's well below the 6-month average. Not like earth shattering here, but this is the slowing in the job market that we are expecting. The market reaction is trading off of the headline, but I think the story here is much more about private payrolls, and that is actually a very different headline. Now we'll see if the market eventually picks up on that as the end of the day.
Jeff, you're right. I always say it. So let's rewind 15 minutes. The first move is not always the right move. So let's wait and see what happens later in the day. There you go, Jeff. I got it out. Jeff, let's talk about what we're seeing in private payrolls then, and talk about this move in the market. Would you fade what we're seeing? High yields at the front end. Would you fade what we're seeing in the FX market? A stronger dollar?
Yeah, I mean, that's basically my point, is that the initial reaction here may be a bit overstated with regards to repricing. Now, I agree with you. I think July may have been, overstated to begin with. But I think the broader story here is the slowing in the payrolls that we've seen for some time. I think it's actually confirmed by this report. And then I want to reemphasize what Torsten just said, because I couldn't agree more, that it's really going to be about profit margins and what we learn from corporations. I think you used, Torsten, the pig and the python. That's exactly it. I mean, we're still waiting for the impact to show up. It's been showing up. And the other story around payrolls is they've been overstated. And so the big question is there an underlying weakening here that is a little bit greater than what is anticipated? I think the story here today of headline versus privates is kind of throwing more confusion in there. The revisions were a surprise to the upside. People looking for, the revision story to show up. So that was a little bit stronger than expected. But I think it's really going to be about the corporate reaction here. And it's been, as we saw in the JOLTS data, it's been a pretty stagnant, very, benign kind of layoff environment. We have to see whether or not that is maintained.
But Jeff, isn't this kind of conducive to risk assets? And I say this at a time when you have a potentially stimulative bill coming out of Washington, D.C., albeit increasing the deficit. But you have sort of steady, if slowing, growth at the same time that you have a Fed that is poised to cut rates in September and potentially again later this year. Isn't that potentially still okay for everything to continue on the status quo?
Well, yes, in some sense that's the case, but it's already well into the price. So you look at like the performance of cyclicals versus defensives, for example, you're seeing, expansionary type moves in the face of that. You said slowing but steady. I'd emphasize more the slowing. Most of the economic data is slowing, and that's what the payroll data here is validating. Now, it's not the end of the world, and it's not saying the sky is falling or there's recession, but this is consistent with a mid-cycle slowdown. So there's a little bit of a disconnect between kind of what we're seeing in valuations and what we're seeing in terms of the slowdown. And that doesn't necessarily, mean you jump in with both feet and everything's sky is clear. You got to take a little bit of caution with respect to what's in the price versus what we're seeing in terms of the macro backdrop.